In September 2008, U.S. policymakers made a decision. They allowed Lehman Brothers to fail. They believed markets could absorb one controlled bankruptcy. They misread systemic leverage. That decision froze global credit within days. Lehman was not an isolated institution. It was a counterparty web across derivatives, repo markets, and interbank funding. Allowing its collapse reshaped liquidity flows, credit confidence, and sovereign balance sheets. The weekend decision did not just bankrupt a bank. It destabilized the global funding architecture. This is not a morality tale. It is a structural indictment of incentive blindness, policy illusion, and system leverage miscalculation. The failure was not sudden. It was compounding for years. The weekend was exposure. The fragility was pre-existing. Before the weekend, Lehman appeared solvent. Reported capital ratios met regulatory thresholds. Rating agencies maintained investment-grade classifications. This was the blind spot. Inside the system, leverage exceeded 30-1. Short-term funding financed long-duration mortgage assets. The illusion of control was reinforced by precedent. Earlier in 2008, policymakers had intervened to support Bear Stearns. Markets internalized a signal. Systemic firms would not be allowed to fail. This was the command illusion. Executives optimized for quarterly survival. Policymakers optimized for political optics. No actor optimized for structural resilience. False stability formed from mutual assumption. Each participant believed someone else would absorb the shock. By September, liquidity was deteriorating. Potential buyers examined Lehman's balance sheet. They encountered opaque Level 3 assets and uncertain mortgage exposure. Internal intelligence warned of collateral fragility. Funding desks saw repo haircuts widening. Yet leadership resisted asset fire sales.
Why?
Ego distortion and incentive preservation. Executive compensation structures rewarded reported capital stability. Admitting insolvency would crystallize loss and personal failure. On the policy side, political survival behavior intensified. After public backlash from earlier bailouts, officials feared moral hazard accusations. The debate narrowed to optics. Rescue again or draw a line. Systemic interdependence was acknowledged, but underestimated. The decision to withhold federal support was framed as discipline. It functioned as systemic ignition. On September 15, 2008, Lehman filed for bankruptcy. The counterforce was not a competitor. It was interbank distrust. Money market funds faced redemption pressure. One major fund broke the buck. Repo markets seized. Institutions stopped rolling short-term funding, not only for Lehman but for each other. This was the silent escalation made visible. The system had relied on confidence as collateral. When Lehman failed, counterparties recalculated exposure across the network. No model captured the speed of contagion. Policy architects assumed damage would be contained. Instead, credit spreads widened globally within days. The collapse was not Lehman's alone. It was the freezing of trust, the core operating mechanism of modern finance. The bankruptcy triggered a liquidity migration. Capital did not disappear. It retreated. Interbank lending rates spiked. Credit default swap spreads widened across institutions with no direct exposure to Lehman. This was leverage blindness exposed. Financial institutions had optimized for return on equity, not shock absorption. Thin capital buffers amplified minor asset revaluations into solvency fears. Inside the policy apparatus, fear-based leadership intensified. Officials recognized the accelerating freeze. Yet initial public messaging emphasized contained impact. This was intelligence dismissal under political pressure. Admitting systemic fragility risked public panic. Denying it accelerated distrust. Within days, commercial paper markets contracted sharply. Corporations struggled to finance payroll and inventory. The decision not to rescue one institution became a signal shock to all institutions. False stability collapsed into coordinated hesitation. The market's core function, trust, had repriced to zero. The weekend decision forced rapid policy reversal. Within 48 hours, authorities intervened to stabilize American International Group. The inconsistency was structural. Lehman was allowed to fail. AIG was rescued. Markets interpreted this not as strategy, but improvisation. This triggered the policy illusion collapse. Participants no longer believed in a coherent doctrine. They began pricing in uncertainty at the sovereign level. Equity markets fell sharply. Liquidity facilities expanded. Emergency lending mechanisms multiplied. The incentive distortion became visible. Political actors now optimized for systemic survival, not ideological consistency. The earlier refusal to rescue Lehman was reframed internally as a miscalculation. But the damage had migrated. The collapse was no longer institutional. It was confidence architecture failure across borders. The system had revealed its hidden dependency, coordinated belief. Behind closed doors, fragmentation intensified. Treasury officials, central bankers, and legislators disagreed on scale and authority. The proposed stabilization framework faced resistance in Congress. Public anger over perceived Wall Street protection escalated. Political survival behavior began overriding structural clarity. Lawmakers feared voter backlash. Executives feared criminal liability. Regulators feared historical blame. This environment delayed decisive stabilization measures. The hesitation reinforced volatility. Markets do not price intentions. They price execution credibility. Each delay widened spreads further. Meanwhile, global institutions recalibrated exposure to U.S. counterparties. The strategic migration had begun. Fragility was no longer confined to investment banks. It moved into sovereign balance sheets and currency markets. The collapse expanded because leadership cohesion fractured at the moment coherence was required. The freeze propagated through structured finance. Securitization market stalled. Mortgage origination contracted sharply. Regional banks faced funding strain. Corporations deferred investment. Hiring slowed. The public damage unfolded quietly at first. Credit contraction preceded visible unemployment. This was the blind spot repeating at scale. System leverage had accumulated during expansion. The unwind required synchronized deleveraging. No actor wanted to sell first. No actor trusted last resort liquidity assurances. Cultural inertia persisted within institutions. Risk models still referenced historical volatility ranges that no longer applied. The chain reaction demonstrated a structural principle. When leverage and confidence are intertwined, policy hesitation becomes accelerant. The weekend decision did not create fragility. It exposed and synchronized it. The deeper failure was not bankruptcy. It was structural leverage opacity. Modern finance had engineered complexity faster than oversight capacity. Off-balance sheet vehicles. Securitized mortgage tranches. Short-term wholesale funding dependence. Institutions modeled risk as localized. In reality, exposure was networked. The assumption, diversification reduced vulnerability. The reality, correlation converged under stress. Inside boardrooms, executives relied on value-at-risk metrics calibrated to stable periods. This was quantitative overconfidence. Internal intelligence flagged liquidity fragility months earlier. But cultural inertia suppressed escalation. Admitting systemic vulnerability would have forced capital raises. Capital raises would have signaled weakness. Incentives rewarded calm projections. The system was leveraged not only financially, but psychologically. False stability masked synchronized exposure. When Lehman failed, it did not introduce risk. It revealed shared fragility already embedded across balance sheets. Policymakers believed discipline would restore credibility. Allowing one firm to fail was framed as restoring market accountability. This was the command illusion. They assumed markets differentiated between isolated failure and structural instability. But funding markets operate on counterparty confidence, not moral philosophy. The decision created an asymmetry. If one systemic institution could fail, all could. Capital preservation became rational. Liquidity hoarding accelerated. Within weeks, the U.S. government introduced the Troubled Asset Relief Program under the United States Department of the Treasury. The shift was abrupt. Non-intervention transformed into large-scale recapitalization. The inconsistency reinforced perception of reactive governance. Political leaders feared appearing weak before crisis. They appeared uncertain during crisis. Policy hesitation converted solvency concerns into existential doubt. The illusion was control. The exposure was improvisation. The collapse migrated from institutions to households. Credit contraction limited small business financing. Mortgage defaults accelerated. Retirement portfolios declined sharply. The public had not engineered structured credit instruments. Yet public balance sheets absorbed the aftermath. This is the incentive distortion at macro scale. Private gains had been optimized. Systemic risk had been socialized. Trust in financial institutions deteriorated. Trust in regulators followed. When governments guaranteed deposits and expanded liquidity facilities, stability returned gradually. But credibility did not. Cultural memory formed. Policy architects had believed opacity prevented panic. Instead, opacity amplified suspicion. The weekend decision symbolized something larger. That system guardians did not fully understand system complexity. Confidence, once fractured, does not restore at the speed of liquidity injections. It restores at the speed of institutional reform, which lags. The immediate freeze stabilized over months. The structural consequences persisted for years. Central bank balance sheets expanded dramatically. Interest rates fell toward zero. This introduced a new dependency, monetary accommodation as structural support. Risk pricing adjusted to expectation of intervention. The strategic migration had completed. Fragility moved from investment banks to sovereign debt levels to asset price inflation. Institutions learned a distorted lesson. Systemic collapse would trigger rescue. This altered incentive architecture. Leverage did not disappear. It relocated. The weekend that froze global markets reshaped policy doctrine and investor psychology. The visible crisis ended. The underlying pattern evolved. The immediate collapse eliminated one institution. The structural outcome consolidated others. Deposits migrated toward institutions perceived as too interconnected to fail. Balance sheet concentration increased. This was not market cleansing. It was power redistribution. Regulatory frameworks tightened under the Dodd-Frank Act. Capital requirements increased. Stress testing formalized surveillance. Yet incentive architecture remained conflicted. Large institutions gained implicit state backing. Smaller institutions absorbed compliance cost. This reinforced the command illusion at scale. Consolidation was interpreted as stability. In reality, systemic nodes became larger and more politically entangled. Political survival behavior deepened coordination between regulators and major banks. The system became safer in buffers, but more dependent on central authority. Fragility did not disappear. It centralized. Zero interest rate policy extended for years. Asset prices recovered rapidly. Wage growth lagged. This divergence produced cultural instability. The public internalized a perception. Finance recovers first. Households recover last. Trust erosion became political fuel. Movements across ideological spectrums cited 2008 as proof of elite insulation. The blind spot had migrated into democratic systems. Meanwhile, corporations increased leverage again, assuming low borrowing costs were durable. Risk models recalibrated to suppressed volatility. Incentive distortion reformed under new language, accommodation, support, liquidity management. The structural damage was not only economic. It was epistemic. Confidence in institutional foresight weakened. When credibility declines, policy tools lose transmission power. The crisis had ended operationally. It had not ended psychologically. The pattern did not remain in finance. Technology platforms later exhibited similar leverage blindness, not financial, but infrastructural. Energy markets demonstrated exposure to concentrated supply chains. The fortress illusion reappeared across sectors. Dominance interpreted as durability. Command assumed resilience. Internal intelligence muted to preserve valuation optics. The 2008 weekend teaches a recurring doctrine. Complex systems fail at connection points. Leaders optimize visible metrics. They discount interdependence. The silent escalation forms beneath performance narratives. By the time exposure surfaces, containment options narrow. The strategic migration principle applies universally. Failure does not vanish after correction. It relocates to the next incentive distortion. The pattern is portable. The variables change. The psychology does not. The Lehman weekend was not chaos. It was cumulative miscalculation meeting political hesitation, false stability, leverage blindness, policy illusion, intelligence dismissal. Each signal was visible before collapse. The charge is not that leaders lacked data. It is that incentives reshaped interpretation of data. The command illusion persists wherever authority mistakes control for foresight. Today, leverage exists in new forms. Private credit expansion, sovereign debt accumulation, shadow liquidity mechanisms. The question is not whether fragility exists. It is where interdependence is being discounted. Systemic collapse does not announce itself. It compounds quietly inside incentive structures. When exposure arrives, it appears sudden. It is not. The pattern is forming again.